Hey everyone, welcome back to the channel. I know it's been a while since I uploaded a video, and I want to say a big thank you for your patience. Life's been a bit hectic, but I'm here now, and today's topic is something a lot of you have been asking about: crypto taxes in India and any way to save taxes on it. Now I know taxes can feel overwhelming, especially when it comes to crypto. But don't worry, I've done a ton of research, and I'm here to break it all down for you in a way that's easy to understand. Whether you're a beginner or a seasoned trader, this video will cover everything you need to know, from how crypto is taxed to legal ways to minimize your tax burden. So let's dive in. What are cryptocurrencies? First, let's start with the basics. Cryptocurrencies are digital or virtual currencies that use cryptography for security. Unlike traditional money issued by governments, crypto operates on decentralized networks powered by blockchain technology. The most well-known cryptocurrency is Bitcoin, but there are thousands of others like Ethereum, Litecoin, and Ripple, often called altcoins. Crypto can be used for peer-to-peer, P2P transactions, remittances, and even as an investment. You can trade it on exchanges, store it in digital wallets, and in some cases use it to buy goods and services. But here's the catch: crypto is taxed in India, and understanding how it works is crucial to avoid any surprises. Is crypto taxed in India? Yes, absolutely. In the 2022 budget, the Indian government officially recognized cryptocurrencies as virtual digital assets, VDAs, and introduced a specific tax framework for them. Here's how it works. 1. 30% tax on profits. If you make a profit from selling, trading, or spending crypto, you'll pay a flat 30% tax on that gain. This applies whether you're selling crypto for Indian rupees or trading one crypto for another. TDS on transactions. Starting July 1st, 2022, a 1% TDS is deducted on crypto transactions exceeding 50,000 rupees in a financial year, or 10,000 rupees in certain cases. This applies to both Indian and international exchanges. 3. Reporting crypto income. You must declare your crypto income as either capital gains, if held for investment, or business income, if held for trading. Which crypto transactions are taxed? Not all crypto transactions are taxed the same way. Here's a quick breakdown. Buying crypto. When we buy crypto, there is no tax, but a 1% TDS is deducted by the exchange, P2P and international trades. Selling crypto? For selling crypto, there is 30% tax on profits, plus 1% TDS. Trading crypto for crypto. For trading crypto, there is 30% tax on profits, plus 1% TDS. Spending crypto. For spending crypto to purchase something, there is 30% tax on profits. Holding crypto are tax-free until sold or traded. Transferring between wallets are tax-free until sold or traded. For example, if you buy Bitcoin and hold it for years without selling, you won't pay any tax. But if you sell it later and make a profit, that profit will be taxed at 30%. What about airdrops, forks, and gifts? Crypto isn't just about buying and selling. Things like airdrops, hard forks, and gifts also have tax implications. Airdrops: if you receive free tokens from an airdrop, you'll pay income tax at your slab rate based on their market value. But if you sell them later, you'll pay 30% tax on any profit on that extra amount. Hard forks: new coins from a hard fork are taxed as income when received, but selling them later incurs a 30% tax on profits. Gifts: crypto gifts are usually taxed, but there are exceptions. Gifts from close family or under 50,000 rupees in a financial year are tax-free. Legal ways to save on crypto taxes. Now let's talk about legal ways to minimize your tax burden. I know a lot of you are looking for ways to save, so here are some strategies. 1. Use the old tax regime for rebates. If your total income is under 5 lakh rupees, you can claim a tax rebate under Section 87A, which can reduce your tax liability to zero. This applies to crypto profits if you file under the old tax regime. 2. Trade crypto futures. Unlike spot trading, futures trading is treated as business income, meaning you can offset losses against other income. Plus, it's taxed at your income slab rate, not the flat 30%. 3. Use decentralized wallets. For small, everyday transactions, decentralized wallets can help you avoid unnecessary reporting. Just remember, when you cash out to your bank, you'll need to declare any profits. Using decentralized wallets for small transactions. Now let's talk about decentralized wallets. If you're someone who does a lot of small crypto transactions, maybe sending crypto to friends, paying for services, or just moving funds around, you might be wondering how to handle taxes for these. Here's the thing. The government doesn't track decentralized wallets. That means if you're using a wallet like MetaMask or Trust Wallet for small transactions, the government won't know about it unless you bring those funds back to a centralized exchange or your bank account. For example, let's say you use your decentralized wallet to send $50 worth of crypto to a friend for splitting a bill. The government won't know about this transaction because it's not recorded on a centralized platform. But if you later transfer $200 worth of crypto from your decentralized wallet to a centralized exchange or bank or P2P like Binance or CoinDCX, etc., and then withdraw it to your bank, the government will know about that $200. In this case, you'll need to declare that $200 as profit and pay 30% tax on it. But here's the key. You don't need to report every small transaction you made in your decentralized wallet. Just focus on the funds you bring back to your bank account. Example, how to handle decentralized wallet transactions. Let's say you've been using a decentralized wallet for a year, and here's what your transactions look like. Sent $5 to a friend for dinner. Paid $3 for an online service. Received $100 from a freelance gig. Transferred $200 to a centralized exchange and withdrew it to your bank. In this scenario, you only need to declare the $200 you withdrew to your bank. The other transactions, $5, $3, and $100, don't need to be reported because they were done in a decentralized wallet and you could just directly file for the profit amount. Trading crypto futures, a legal way to save on taxes. Now let's talk about crypto futures trading. This is one of the most effective legal ways to reduce your crypto tax burden in India. Here's why. Unlike spot trading, where profits are taxed at a flat 30%, futures trading is treated as business income. This means you can offset losses against other income, and your profits are taxed at your income slab rate, which could be much lower than 30%. For example, if you're in the 10% tax slab, you'll pay 10% tax on your futures trading profits instead of 30%. Plus, if you incur losses, you can use them to reduce your overall tax liability. Example, futures trading versus spot trading. Let's say you're a crypto trader with the following transactions. Spot trading. Bought one Bitcoin for 20 lakh rupees. Sold it later for 25 lakh rupees. Profit, 5 lakh rupees. Tax, 30% of 5 lakh rupees equals 1.5 lakh rupees. Futures trading. Made a profit of 5 lakh rupees from futures trading. Tax, assuming 10% slab. 10% of 5 lakh rupees equals 50,000 rupees. As you can see, futures trading saves you 1 lakh rupees in taxes compared to spot trading. Important note, leverage in futures trading. Now, I know what you're thinking, but futures trading involves leverage, and that's risky. You're absolutely right. Leverage can amplify both your gains and your losses, and it's not for beginners. But here's the thing. You don't have to use leverage. You can trade futures with 1x leverage, which is essentially the same as spot trading, but with the tax benefits of futures. For example, if you buy a Bitcoin futures contract with 1x leverage, your position will move exactly like spot trading, but your profits will still be taxed as business income. P2P trading. Why it's risky. A lot of people use P2P, peer-to-peer trading, to buy and sell crypto, thinking it's a way to avoid taxes. But let me tell you, P2P is one of the riskiest ways to trade crypto. Here's why. Scammed payments. Many P2P transactions involve scammed funds. If you receive money from a fraudulent source, your bank account could get frozen, and you'll have to prove the legitimacy of the transaction. Tax notices. The government can track P2P transactions, especially if large amounts are involved. If you can't prove the source of the funds, you could face penalties or even legal action. I've personally faced issues with P2P, and it took me 2 years to resolve them. Trust me, it's not worth the hassle. Example, on P2P risks. Let's say you sell 1 lakh rupees worth of crypto through P2P. The buyer sends you the money, but it turns out the funds were from a scam. Your bank flags the transaction, freezes your account, and asks you to prove the source of the funds. If you can't provide proof, you could lose access to your money and all the funds in your bank account, and also could face legal consequences. That's why I always recommend using centralized exchanges for payouts, even if the rates are slightly lower. Same happens for crypto. If you're not aware, crypto scams can be reported and tracked. For example, if someone sends you crypto via peer-to-peer, P2P, and it turns out to be fraudulent, your exchange will likely lock your account along with all your funds, just like a bank would. So to avoid these risks, I strongly suggest to avoid P2P transactions. Always prioritize security, using current accounts for crypto transactions. One last tip, if you're doing a lot of crypto transactions, don't use a savings account. Instead, open a current account. Here's why. Savings accounts. These are designed for personal use, and banks monitor them closely for unusual activity. If you receive large or frequent crypto-related payments, your account could get flagged. Current accounts. These are meant for business transactions, so they're better suited for crypto payouts. Some banks even offer zero-balance current accounts with minimal documentation. For example, if you're a freelancer receiving crypto payments, using a current account can help you avoid unnecessary scrutiny from your bank. Using foreign exchanges, the half-truth about avoiding taxes. Now let's talk about foreign exchanges. A lot of people think that using international platforms like Binance or KuCoin is a way to avoid taxes in India. But here's the reality. It's a half-truth. Yes, some foreign exchanges aren't fully compliant with Indian regulations, and they might not share your transaction data with the Indian government. But that doesn't mean you're completely off the radar. Here's why. Card payments. If you use your Indian debit or credit card to buy crypto on a foreign exchange, your bank will know about it. The government can track these transactions through your bank statements. P2P transactions. If you use P2P on a foreign exchange, the government can still track the money coming into your bank account. They might not know the exact details of the crypto transaction, but they'll know you're receiving funds from someone who's involved in crypto. For example, let's say you buy $1,000 worth of Bitcoin on a foreign exchange using your Indian card. Your bank records the transaction, and the government can see that you've spent money on a crypto platform. Even if the exchange doesn't share your data, the government can still connect the dots. Example, on foreign exchange, P2P risk. Let's say you use a foreign exchange to trade crypto and make a profit of 2 lakh rupees. You withdraw the funds to your Indian bank account through P2P. The government sees the 2 lakh rupees coming into your account and asks you to explain the source of the funds. If you can't provide proper documentation, you could face penalties or even legal action. And here's the kicker. The government can send you a tax notice years later, asking you to prove the legitimacy of the transaction. By then, you might not even have the records to back it up. P2P is one of the riskiest ways to trade crypto. The safest option to withdraw funds to bank is by centralized exchanges. If you want to avoid unnecessary risks, stick to centralized exchanges that are compliant with Indian regulations. Yes, the rates might be a bit lower, but it's worth it for the peace of mind. For example, if you sell 1 lakh rupees worth of crypto on a centralized exchange, the platform will deduct the 1% TDS and report the transaction to the government. You'll pay the 30% tax on your profits, but you won't have to worry about your bank account getting frozen or receiving a tax notice years later. Why is P2P bad? I've talked about this before, but let me explain again. P2P is risky, and you aren't saving anything. Avoiding tax doing P2P in exchanges, rather risking a lot more. I'll make a dedicated video to explain this in more detail, but for now, just know that P2P is not worth the risk. Understanding tax rebate under Section 87A. Now, let's talk about one of the most helpful provisions for low-income earners, the tax rebate under Section 87A. This rebate can significantly reduce your tax liability or even bring it down to zero if your income falls below a certain threshold. Here's how it works. If your total taxable income is below 5 lakh rupees under the old tax regime, you can claim a rebate of up to 12,500 rupees. If your tax liability is less than 12,500 rupees, the rebate will cover the entire amount, meaning you won't have to pay any tax. If your tax liability is more than 12,500 rupees, you'll only pay the amount above the rebate. But here's the catch. This rebate doesn't apply to crypto income under the new tax regime. So if you want to claim the rebate on your crypto profits, you'll need to file your taxes under the old tax regime. Example on how the rebate works. Let's say there's a crypto trader named Rahul. He's a part-time trader with an annual income of less than 5 lakh rupees. In the financial year 2024 to 2025, he made a profit of 40,000 rupees from selling Bitcoin. Here's how his taxes would work. Capital gains tax, 30% of 40,000 rupees equals 12,000 rupees. Cess, 4% of 12,000 rupees equals 480 rupees. Total tax liability, 12,000 rupees plus 480 rupees equals 12,480 rupees. Now, since Rahul's total income is below 5 lakh rupees, he's eligible for the tax rebate under Section 87A. The maximum rebate he can claim is 12,500 rupees. Since his tax liability, 12,480 rupees, is less than 12,500 rupees, the rebate covers the entire amount. This means Rahul's final tax liability is 0 rupees. Why the old tax regime is better for small crypto traders? If you're a crypto trader with a low income, filing under the old tax regime can save you a lot of money. Here's why. Rebate eligibility. You can claim the 12,500 rupee rebate if your income is below 5 lakh rupees. Lower tax slabs. The old regime often has lower tax slabs for individuals with moderate incomes. For example, if you're in the 10% tax slab, you'll pay 20% tax on your crypto profits under the old regime, compared to the flat 30% under the new regime. Important note: rebate isn't allowed on crypto income under the new regime. Under the new tax regime, the rebate under Section 87A doesn't apply to crypto income. So if you're filing under the new regime, you'll have to pay the full 30% tax on your crypto profits even if your total income is below 5 lakh rupees. That's why it's crucial to choose the right tax regime based on your income and crypto activities. If you're a low-income earner with crypto profits, the old tax regime is usually the better option. Who is eligible for the Section 87A tax rebate? Not everyone can claim the tax rebate under Section 87A. Here's who qualifies. Resident individuals. Only resident individuals can claim this rebate. If you're a non-resident, you're not eligible. Income threshold. Your total taxable income must be below 5 lakh rupees in a financial year under the old tax regime. Rebate cap. The maximum rebate you can claim is 12,500 rupees. If your tax liability is less than 12,500 rupees, the rebate will cover the entire amount and you won't have to pay any tax. For example, if you're a freelancer or part-time crypto trader with an annual income of 4.8 lakh rupees, you're eligible for the rebate, but if your income is 5.5 lakh rupees, you won't qualify. Steps to calculate and claim the rebate. If you're eligible for the Section 87A rebate, here's how you can calculate and claim it. Step 1. Calculate your gross total income, GTI. Add up all your income sources including salary or business income, crypto profits, capital gains or business income, interest from savings accounts or fixed deposits, any other income like rental income or freelance earnings. For example, let's say your income breakdown looks like this. Salary, 3 lakh rupees. Crypto profits, 1.5 lakh rupees. Interest income, 50,000 rupees. Total GTI, 5 lakh rupees. Step 2. Subtract deductions. Next, subtract any deductions you're eligible for under Chapter 6A of the Income Tax Act. Common deductions include Section 80C, investments in PPF, ELSS or life insurance premiums, up to 1.5 lakh rupees. Section 80D, health insurance premiums. Section 80 T.A, interest on savings accounts, up to 10,000 rupees. For example, if you've invested 1 lakh rupees in PPF and paid 20,000 rupees in health insurance premiums, your total deductions would be 1.2 lakh rupees. Step 3. Calculate your total taxable income. Subtract your deductions from your GTI to get your total taxable income. GTI, 5 lakh rupees. Deductions, 1.2 lakh rupees. Taxable income, 3.8 lakh rupees. Step 4. Calculate your tax liability. Now calculate your tax liability based on the old tax regime. Income up to 2.5 lakh rupees, 0% tax. Income from 2.5 lakh rupees to 5 lakh rupees, 5% tax. For 3.8 lakh rupees, tax on 2.5 lakh rupees, 0.000 rupees. Tax on 1.3 lakh rupees, 5% of 1.3 lakh rupees equals 6,500 rupees. Step 5. Apply the rebate. Since your taxable income is below 5 lakh rupees, you're eligible for the 12,500 rupees rebate. Your tax liability is 6,500 rupees, which is less than 12,500 rupees, so the rebate covers the entire amount. Step 6. File your taxes. When filing your income tax return, ITR, make sure to choose the old tax regime. Declare your crypto income under Schedule VDA, Virtual Digital Assets. Claim the Section 87, a rebate in the appropriate section. Why you should hire a chartered accountant. Now, I know all this can feel overwhelming, especially if you're new to crypto or taxes. That's why I always recommend hiring a chartered accountant, CA, to handle your taxes. Here's why. Expertise. A CA knows all the ins and outs of tax laws, including crypto taxation. They can help you maximize deductions and minimize your tax liability. Accuracy. Filing taxes can be complicated, and even small mistakes can lead to penalties. A CA ensures everything is done correctly. Time saving. Instead of spending hours figuring out tax forms and calculations, you can focus on your crypto trading or other work while your CA handles the paperwork. For example, if you're unsure how to classify your crypto income as capital gains or business income, a CA can guide you and ensure you're filing correctly. Common questions about crypto taxes. Alright, so now you might be thinking, I've understood all the information you've shared, but I just want a quick answer. Do I really need to file taxes if I'm only doing small transactions? The short answer is yes, you need to file taxes. It's government mandated and we can't avoid it. But let me break it down for you. If you're doing very minimal transactions or making very small profits, the government might not actively look into your activities. But here's the thing, the process is still the process. Even if your transactions are small, it's better to stay compliant. For crypto, the government has made it clear you have to file taxes. It's not optional, especially if you're making profits. So, even if it feels like a hassle, it's better to be safe than sorry. What about crypto cards and other services? Now, some of you might be using crypto cards or other services and wondering, how will the government track me? Here's the reality. They will know. When you use a crypto card to make purchases or withdraw money from an ATM, the government can track those transactions. Why? Because every service you use, whether it's a crypto card, exchange or wallet, has to comply with AML anti-money laundering policies. If the government asks for your transaction data, these services are legally required to share it. So even if you think you're flying under the radar, the government can still connect the dots. Are decentralized wallets legal? This is a question I get a lot. Are decentralized wallets legal? Can I use them without worrying about taxes? The truth is, decentralized wallets fall into a gray area. The government wants you to report your crypto holdings and pay taxes on any profits. But here's the catch. Decentralized wallets are hard to track. People use decentralized wallets for different reasons. Some use them for privacy. Some use them for convenience. And yes, some use them for scams. If you're doing small transactions, like sending $1 to a friend for helping you out, it's almost impossible to keep track of every single transaction. That's why decentralized wallets are a good option for small, everyday transactions. But remember, you still need to pay taxes on profits. If you're making money, the government expects its share. So while decentralized wallets give you some privacy, they don't give you a free pass to avoid taxes. There is nothing like avoiding all taxes, etc. It's just how you use it based on convenience. People can do a lot of transactions in the decentralized wallet, but once you withdraw the money to your bank, the government will know about it and be able to connect the dots, check the transitions, etc. That's the end of it. Do I have to file taxes if I use Re.Pay? If you're using Re.Pay or any other platform, the answer is, it depends. If you're doing very small transactions and your profits are minimal, you might not need to worry too much. But if your transactions are larger or your profits are significant, you should file your taxes. For example, if you're making 10,000 rupees in profit, it's better to declare it and pay the 30% tax. But if you're only making 500 rupees, the government might not come after you. Still, it's always better to stay compliant. Do I pay tax when buying USDT? Here's a quick answer. No, you don't pay tax when buying USDT. You only pay tax when you make a profit or use crypto to pay for goods or services. So if you're just buying USDT and holding it, there's no tax. But if you sell it later and make a profit, you'll pay 30% tax on that gain. Crypto tax is complicated. What should I do? I get it. Crypto tax can feel overwhelming. If you're struggling to understand it, hire a chartered accountant CA. A CA can handle all the complicated stuff for you. They'll calculate your taxes, file your returns, and make sure you're compliant with the law. And the best part? Their fees are usually minimal, and you only need to pay them once a year. Whether you choose an online CA or a local one, it's a small investment that can save you a lot of time and stress. Can I avoid paying taxes completely? The short answer is no, you can't avoid taxes completely. The only way to pay zero tax is if you live in a tax haven country. But if you're in a country like India, you'll need to follow the rules. What if I don't trust this information? I get it. There's a lot of misinformation out there. But here's the thing. I've done my research. I use crypto myself, and I've gone through the process of filing taxes. I'm not just copying information from other videos. If you don't trust me, that's okay. Talk to a chartered accountant or do your own research. But remember, staying compliant is always the best option. So I'm not a business owner. Do I still need to pay tax? Even if you're not running a business, you still need to pay taxes on crypto profits. Filing taxes is just a way of letting the government know how much you've earned. And with rebates and deductions, you might end up paying zero tax if your profits are small. I'm working for a company and they're paying me in crypto. Do I have to pay 30% tax on that? The answer is, it depends. Let me explain how. Let's say your company pays you 10,000 USDT, a stablecoin, and the current market value is 80 rupees for 1 USDT. Now you have two options. If you sell the USDT immediately, you'll report the 80 lakhs as part of your income. You'll pay tax on this 8 lakh rupees according to your income slab, like 5%, 20%, or 30%, depending on your total income. If you hold the USDT and its value increases, let's say after a few months, the price of 1 USDT goes up to 85 rupees. You'll still report the original 8 lakh rupees as income and pay tax according to your income slab. But now you've made an extra 5 rupees per USDT. 85 rupees minus 80 rupees equals 5 rupees. So 5 rupees times 10,000 equals 50,000 rupees is your profit. On this 50,000 rupee profit, you'll pay 30% tax. What if your company pays you in other crypto, like Bitcoin? It's the same process. If you sell the crypto immediately, you'll report the amount as income and pay tax according to your income slab. If you hold the crypto and its value increases, you'll pay 30% tax on the profit when you sell it. Let's say you decide to stake or lend in crypto, for example, $1,000. Here's what happens with taxes. You stake or lend $1,000. Later, you earn a reward, let's say 0.1 ETH, which is worth $200 at the time you receive it. The $200 reward is treated as regular income. You'll pay tax on this $200 according to your income slab, like 5%, 20%, or 30%, depending on your total income. You do not pay 30% tax on this $200. Now let's say you hold the 0.1 ETH and its value goes up from $200 to $300. When you sell it, you'll pay income tax on the original $200 as per your income slab, 30% tax on the extra $100 profit. $300 minus $200 equals $100. Freelancer receiving payments in crypto. If you're a freelancer in India and you receive payments in crypto, here's what happens. The government treats freelancing as not a proper business, so there is no clear framework for crypto payments. If you receive crypto for your services, you'll likely have to pay 30% tax on the amount you receive. Why? Because the government doesn't have a way to verify the exact amount or source of the payment. Unlike companies, freelancers don't have salary slips or proper documentation to prove the payment. Registered business receiving payments in crypto. If you're running a registered business and receiving payments in crypto, it's a bit different. Since your business is registered, you can issue invoices for crypto payments. You can show these invoices to the government as proof of payment. In this case, you will most likely not have to pay 30% tax. Instead, you can report the payment as part of your business income and pay tax according to your income slab. However, there's no clear rule or confirmation from the government, or I could find about this. So it's a bit of a gray area. Additionally, there are multiple service providers available who help convert crypto into fiat or local currency and directly send it to your business bank account. This allows you to pay taxes according to your business income. These service providers first conduct Know Your Business (KYB) verification to confirm the legitimacy of your business. Once verified, they approve and facilitate the transactions. So I believe that registered businesses probably not be taxed at 30%. Still, I would ask you to verify these informations from your CA. Final thoughts? Crypto taxes can be complicated, but they're not impossible to handle. Whether you're a beginner or an experienced trader, the key is to stay informed and stay compliant. If you're ever in doubt, talk to a professional. It's better to spend a little money on a CA than to face penalties or legal issues down the line. Alright, that's about it for this video. I've tried to cover everything I could, and I hope it's been helpful. If there's anything else you want me to talk about, let me know in the comments. I'm always open to your suggestions. Before I wrap this up, I've got a small favor to ask. If you found this video helpful, please hit that subscribe button. It's a huge support for me and helps this channel grow. The more we grow, the better content I can create for you. Plus, it's a way for us to stay connected so you never miss an update. And if you've already subscribed, thank you. You're amazing, and I'm so grateful to have you here. Your support keeps me going, even when things get tough. Thanks for sticking around, and thanks for being such an awesome community. I'll see you in the next video. Until then, take care, and don't forget to stay curious and keep learning. Bye for now.